going to ask a question that may be a little inside baseball, but I've been told that private equity has all but eliminated the IPO. I was wondering what your opinion on that was. That people were just buying chunks with no, or I'm reading the globe wrong.
So you're talking about knowledge that I maybe don't have, right?
No, I think I may be on a hobby horse. I've been told that companies that are investment companies, like the people you mentioned, are buying pieces of companies, holding them longer, and the IPO is either non-existent, way out, or not part of the real puzzle anymore.
Public listing of companies is a risk activity. So if you're in an early stage and you're looking for capital, so it depends on what the private equity company is interested in, right? And whatever the hot flavor of the month is, right?
Or
a week, a day, whatever. They will be interested in investing in those products or whatever it is. And they're going to be segmented into companies that are cash flow stable and investments in companies that are 10 to 1, right? So the investment company is going to have a portfolio view of their investments, right? They're going to say, especially if it's high risk, it's one of these startups, technology startups that doesn't have any history, but it's got great management, right? And it's got a pretty good looking asset. Then they're going to say, okay, well, we'll take $10 million and we'll put $1 million in 10 different investments, and one will be a 10-bagger, and 3 or 4 will be dead on arrival, and the remainder will limp along until we can get rid of them. And if they're really lucky, then maybe 2 out of 10 are 10-baggers, and they'll make all that money. So that's one kind of investment company. And you'll often see, for tech companies, you'll often see that they're going to go to a PE firm like that, a high risk, high reward private equity firm like that, prior to going public, because they have a small number of shareholders. They can use their direct communication with their shareholders to keep them informed and involved in the business. And the shareholders themselves, private equity guys, can then look after their investments. Whereas if you go to a public market listing, there's a lot of distance between management and shareholders because there's so many of them. And there's a whole reporting cost associated with a public listing that you won't find in a private equity funded firm. And so is this answering your question?
That's exactly the question. You answered it.
Okay, good. Because there are different investors for different products, right? That's part of what makes the arbitrage work.